Hello, this is John Sehun with InsiderSentiment.com, and today I will be discussing what is insider sentiment and why is it useful. So perhaps you've heard of insider trading, but you don't know how it pertains to general sort of market research or how it can help investors who are broadly invested in the market, or you don't know how it connects to insider sentiment, and so I'm going to explain that uh, briefly today. And this is content that comes from our blog post called What is Insider Sentiment? And so if you're interested in the full write-up, you can check that out. And I will begin with a metaphor that my former band teacher in middle school used to tell us, who was a great teacher, by the way. And unfortunately, I can't exactly remember the context that he used to tell us this in, but he used to say to us that you don't want to be like a blind man walking into a dark room looking for a black cat that isn't there, right? Clearly, this person has doesn't have a lot of you know navigational abilities and was looking for a cat that doesn't even exist. So, this is quite a unfortunate situation that you wouldn't want to be in. In contrast, we have a ship with a lookout here who has a telescope, and so the telescope allows this lookout of the ship to see oncoming enemy ships or changing conditions or icebergs or what have you. So clearly, the ship here is better able to anticipate changing conditions and navigate accordingly. And so, what I will attempt to argue here is that if you are doing research or investing in the market and you're not um, aware of insider sentiment or what insiders are doing at large, then you are going to be more like the blind man looking for a black cat that isn't there in the dark room versus the lookout, the ship with the lookout who has the better ability to navigate. So, that is what I will attempt to argue here. And so just to give a brief overview, so by insiders we mean directors, officers, and 10% holders of public corporations. And by insider trading, what we're referring to is these insiders buying and selling the stock of the company that they oversee. So this trading activity is regulated by the SEC, and when these insiders make purchase and sale transactions, they're required to report these to the SEC within 2 business days, and all of these transactions are public. So when I say insider trading or insider sentiment, I'm referring to basically these public, publicly available transactions. So what we can do with these transactions is we can aggregate them by grouping them together, and then we can distill them into one number to represent sort of the overall insider activity. And the number we use to do that is the share of companies that report net insider buying in each month. And we call this the insider sentiment tracker. And we claim that it is a forward-looking economic indicator. And so that's kind of rare. There's not very many forward-looking economic indicators, and I will show you an example of why we believe that to be the case. And so here we have the S&P 500 price, and at the time of this recording, it is reaching new all-time highs after a scare due to a potential tariff shock. But I want to focus on the period about 5 years ago. You may recall that there was a pandemic and a lot of fear and uncertainty, and we there was an economic shutdown, and that economic shutdown basically um, caused a lot of supply shocks, and the stock market uh, went down rapidly. So the price here in January before the shutdown was 3,300, and 2 months later the stock market was at 2,300. There, let me just get the pixel. There we go, 2,300, which is quite a significant decrease. That's over a 30% decrease in 2 months, so quite a steep decline. And I'll just interject briefly to say if you're enjoying this content and you want to help the channel, you can like or comment. And if you want to make sure you don't miss any future videos, you can hit the subscribe button. So when the market was going down during that period of uncertainty, what were investors at large doing? So this is a chart from Morningstar, I believe, and here we have these bars that are referring to the global equity return in each month. And on the right y-axis, we have the blue line representing cumulative money market flows, flows to money market funds. And so you can see that while the market was going down, investors at large were basically fleeing to safety. They were scared and looking for safe harbor. And so you can see the money market flows were increasing during this period, and they topped out and then leveled off a little bit. Um, but we can say confidently that investors at large were very scared during this period. So now let's look at what insiders were doing. By contrast, we see that in March 2020, insiders, so this is the insider sentiment tracker, basically as I explained earlier, the proportion of companies that are experiencing net insider buying with some adjustments that we make. And so you can see in March 2020, insiders were buying way more than normal, even, like close to double of the previously um, record high numbers. So, I mean, insiders were buying like a ton at this time. It was basically Christmas for insiders. So that is a sharp contrast from what investors at large were doing, which was fleeing to money market funds. And so, yeah, just to summarize, when investors were scared during COVID shutdowns, fleeing to safety, insiders were busy buying up their own stocks in record numbers. So, again, going back to the metaphor, basically, as we know, the market ended up recovering, right? And so, if an investor was following insiders at the time, they would have ended up more like the ship with the lookout, as opposed to many investors who just fled to money markets and as a result did not get the subsequent uh, increase in the stock market that occurred sort of after the market bottomed out in March. So, all right, that's all for now, and see you next time.